Hi, Matteo. Thank you so much for coming to the Mentor Talk. How's it going?
Not too bad. Thank you so much for having me, Massimiliano. Thank you.
My pleasure. Thank you so much. Today we talk about how mentoring can affect startups in good and bad. Sometimes there is what I call bad mentoring. But before starting, would you like to give an introduction to yourself?
Yeah, thank you very much, Massimiliano. I'll give you an introduction by myself. I started my career in finance nearly 3 decades ago. But very quickly, I realized something was missing. I've been operating as a chief financial officer for the last 19 years. Now, what I found is that finance is very good at reporting what happened, but very poor at creating what should happen in terms of obviously creating wealth. And over time, working across blue chip companies, startups, and scale ups, I kept seeing the same patterns. Basically, business were growing, but they were not becoming more valuable. So that led me in 2017 to design what I now call the High Valuation Triangle, initially in collaboration with the University of Plymouth. Now, it's a system that focuses on how to build businesses that are not just profitable, but actually they are chased by customers, by banks, and by investors, of course. Yeah. And more recently, I capture this thinking in my book, Fell Pivot Scale, which is really a practical framework for founders who want to create wealth, not just revenue.
Thank you so much, Matteo. You have so much experience, right? Coming from finance and moving to startup. Am I right? You're doing pretty many mentoring now, especially even in the Middle East, if I remember well.
Yes, in actual fact, I'm actually currently mentor and lecturer for 91 startups at the Saudi Biotechnology Accelerator. My activity is very vast. I participate into a number of online events where I present really how the business should be structured, what's the right sequence to attract investment. But at the same time, I do one-to-one as well. I do a number of sessions like that. And generally speaking, yeah, I tend to tell them what positioning they should have, what structuring they should have in order to be attractive to customers, of course, but also to investors. Yeah.
Thank you. Let's talk about startups, about founders. Based on experience, what kind of skill set a founders must have to succeed? Being talking and mentoring so many, do you see any common pattern?
Yeah, the pattern I tend to see, I would say the bigger mistake, yeah, is that they confuse activity with value. Now, founders, they usually tend to focus on revenue, on growth. You know, that's the usual pattern you tend to see. They tend to focus on when am I going to hire somebody, when am I going to get the product out there, but they very rarely ask a very simple question: would anyone actually want to buy the business? And by buying means also investing in the business. Yeah. And in many cases, the answer is no, because the business is dependent on the founder, the revenue is not predictable, and there's no real intellectual property that can scale. Or even when there is intellectual property, they tend to follow the wrong sequence. They tend to think that IP is static, is not dynamic. So that's something very important to say as well. So what happens when you have a conversation with a founder? You end up with something that works operationally. Yes, it can work operationally, but does not work financially from an investor perspective. And that's where I see really the gap, and that's really a very, very common pattern, I would say. Yeah.
Let me follow up on this one. Not all the founders, for example, myself, I've been talking to. they are skilled in finance. Many of them, they are not. And you say something extraordinarily important. The company must be investable, or the company must be ready to be bought out. Okay? So where do you see the main problems when, for example, a startup is raising funds and maybe the company, the tech, the product is good, but the company itself is not prepared to get funding?
Yeah, I mean, this is where we can definitely say one thing. Yeah. Now, what you need to build, I mean, this is where obviously came from the lesson that I took back in 2017 at the University of Plymouth. Now, we need to also obviously learn from the lessons from the big businesses. Yeah, there are businesses like, I'll give you a couple of examples, Uber or Amazon. They've been loss-making for more than 10 years, but still the investors kept pouring money into these businesses. So why did they do that? The reason why they did it is because they had two big things that usually startups do not have. The first one is a clear positioning, and secondly is a structure. So the advice I always give to early stage founder is it goes a bit like, start with the end in mind. Okay, so ask yourself, who would buy this business and why? Then build backwards from that. So first you need to answer that question. What After you answer it, then you almost like reverse engineer. So you need to focus on creating something that is transferable, but not only transferable, it needs to be scalable, okay, and predictable. So these are three big qualities, and the trap you really need to avoid is doing everything yourself, because if the business depends on you, it cannot scale, it cannot be sold, and that's really the reality, I would say. Yeah.
That's completely right. When you say a clear position, what do you mean exactly with clear position?
Yeah, this is where I introduced the system with the University of Plymouth, which are now called the High Valuation Triangle. It basically answers the three big question an investor asks, or even customer they have. The first one is really, what do you own? Okay. The second one is, how does it transfer value? The third one is, how does it scale? Now, these are the three big questions you have to answer in front of an investor. Now, these three big questions have an answer, which is the High Valuation Triangle, the system I designed for the University of Plymouth. So effectively, I try to make it very, very simple, because this is how obviously the university was very complimentary about this. So the three elements that really drive valuation. Now, the first one is intellectual property. Now, intellectual property, many people think it's a legal concept. It's actually a commercial concept. It's both defensive and offensive. Defensive means you defend your position. It's offensive because you can actually use it to become scalable, to create revenue streams. And this is where we have the example of the big American businesses that they do it really, really well, especially when they go overseas. So the first side of the high valuation triangle is the intellectual property. As I say, not the legal sense, so not in the legal sense. I mean something that can be replicated, scaled, and monetized consistently. The second side is succession. So meaning the business must work without the founder. In actual fact, the investor, they will buy your absence. They will say, what's the value of your absence? It will be the higher, the better, of course, So investors buy systems, not individual, okay? So they would want to see, okay, what happens if I replace the people, if I replace the founder? They want to see transferable value in that sense. So that answered the question, how do you transfer value? The third question that you need to answer is really, how do you scale? Does it scale? And I usually do scale by increasing your market share, but usually going global, because local businesses are actually capped in valuation. And nowadays, especially in AI-driven economies, you need to start natively think about being global. Because you don't think about being global, in AI-driven economies, your competitors will take advantage of that. So you may lose market share before you gain it. So what I would say when it comes to positioning and structure, when these three elements come together, what happens really? You move from a business that survives to a business that really attracts capital. And that's really the shift that we're looking to see in a business, really.
When you talk about scalability and IP, let me start with IP. With AI today, how defensible can be an IP when many startups today, many founders today, they bid using cloud, using ChatGPT, using AI heavily. And it's because you rely so heavily on AI, everyone can do the same. You don't need to be too much skill in tech anymore.
That's absolutely right. This is why people tend to confuse static IP from dynamic IP. Okay. Now, static IP is what people traditionally tend to think, this is what I own, it's mine, no one can attack me, okay? But static IP is not really the answer. What you need to be able to do with IP, there are 5 stages really with IP. The first one you need to identify. The second one you need to codify, you need to document it. If it's not documented, it doesn't exist, After you document it, you don't start using it. The first stage is to protect it, okay? After you protect it, then you go to the fourth stage, which is commercially embedding. And after you commercially embed it, then you can actually now make it transferable through licensing, through franchising, through distribution, through all those sorts. Now, getting the sequencing wrong is a major mistake. But what you've highlighted is the confusion that many people have at the moment between using AI IP actually, someone else's IP in AI as a tool, yeah? So you're renting somebody else's intelligence as opposed to building your own AI in your own business. What do I mean by that? There's a big difference between AI IP and AI usage, okay? So AI IP is when you transform your assets in your business, your intellectual property, your data, your algorithm, all your system into something that commercially scalable effectively. So you're not just using somebody else's AI, you're not using just ChatGPT. You actually, create the IP in such a way that it becomes embedded into your organization. Say, for example, if you use an AI agent, that's the idea about really commercially embedded AI into your business. So what you are creating is something that is not copyable, is very defensible, because the agent, even though you may not own the agent, but you're using somebody else's agent, for example, it becomes embedded into your business, that it start to really create value, it start to make your IP unique and defensible. Now, obviously, there are other stages with the AI IP that we need to cover. And one of them is, how do you create the so-called data flywheel? Okay. So that's where you start a complex process, which, it revolves around making a recursive self-improvement, where data becomes a flywheel. It starts to feed from itself. It starts to create a system that feeds on itself and becomes better and better every day. That's really very specific with artificial intelligence. Yeah.
Based on experience, Matteo, why so many startups fail to scale?
Okay. Well, in actual fact, yeah, this is why actually I wrote the program for the university in 2017. That's why also I wrote the book. I'll just share the way the cover looks. It's called Fail, People, Scale.
You like
No,
for the book?
okay. So here it is. It's actually the book has got 26 interactive scorecard where you can score yourself against the reason why businesses fail. Effectively, you can correct yourself over time. That's why it's called Fail, Pivot, Scale. You fail, you learn, that becomes data, then you pivot, and then you scale. So it's not a slogan, it's actually a cycle we go through. So the reason why so many startups fail, obviously there's a big list, categorization, but generally speaking, they fail at really answering those three questions very well to an investor. The first one is what do you own? The second one is how do you transfer value? And the third one is how do you scale it? And generally speaking, one of the biggest reason why they fail is they do not really own what we call it in something that is investable. Yeah. So startup may be not funded or funded. So if they are funded and they fail, is because capital was not the limiting factor. The limiting factor was potentially the lack of positioning, the lack of structure. For example, they had no demand, they had no sufficient demand for what they were creating. That's because they didn't study the market well enough. Marketing, people tend to confuse it with promotion. Marketing is the study of supply and demand. Yeah. So in order for you to be a supplier, you need to study the demand, and you need to make sure that your position is very strong in the market. Now, especially in AI-driven economies, we're gonna see this as a real danger, a real risk for business, because today intangibles are driving the economy. The 92% of the value of the S&P 500 is intangible. So you need to really make sure that you can monetize your data. Data is, for example, an asset. You need to monetize it. You need to know how to create algorithm, for example, and then from algorithm, take advantage of it. I'm talking obviously about AI-driven economies in this particular sense. So you tend to fail because you do not position yourself very well in the market. So you do not have a strong intellectual property. On a startup phase, that happens a lot. On a scale-up phase, which means after you've already started to sell your product, businesses fail because there is not the change of identity that should happen with the founder. The founder should step back, should let go, so that effectively you let go to let come. So that's when, for example, the second side of the high valuation triangle is not well properly done. And you have to really create succession for the business to be transferable. So that's very, very important. Now, one of the biggest misconception we find that makes actually it creates a lot of failure is the wrong sequencing when it comes to intellectual property. You have to control it and monetize it after you protect it, not before. Many people think, okay, I have a strong edge on the market. I own intellectual property. I'm gonna start monetize it. You don't do that. First, you need to control it, especially in AI-driven economies. This is gonna be a major danger ahead for many. Make sure that you protect, and two, you control before you monetize it. Yeah.
Let's say I have an idea, okay? Because as you said before, the marketing in terms of understanding supply demand the analysis is not done correctly. So you are proposing something that the market maybe doesn't need at all, or does need on the magnitude that you need to scale your business. Now, if I have an idea, I'm a funder, and after we talk maybe later about first time and second time funder, but if I am first time funder, never done a startup before, I decide, I have an idea, okay? How can I actually validate my idea in a very correct way? Then I'm not going to do something that doesn't make any sense. And after 12 months, I need to close because there is no market at all.
Yeah, this is where identifying your customer is fundamental. Not only you need to identify the customer, but you need to carry out those activities that belong to a marketing activity. So effectively, you need to do lots of survey. You need to validate your product. There are 3 big stages before you're ready to the market. The first one is concept. Concept is the idea. The second is validation. And the third one is deployment, which is preceded by development. Yeah. So, and this is where there's a useful guide, which is, we call it technology readiness level, which can also be used for non-technology business, because that tends to be, nine levels with this, So you start from just an idea to then needing really to validate it. How do you validate an idea? Well, you validate an idea by going to the market, by outreaching, by doing lots of survey as much as possible, and asking questions about what the market would accept. Now, there are situations where there's already a strong information about the market in which you want to operate, yeah? In which particular case, you still have to do the documentation about that comes, from direct contact with customers. So you need to really prove the market by asking those questions. And then initially, you want to start really with the earlier phase of the technology readiness level. For example, creating a pilot. I always say go from pilot to profit, yeah? So a pilot of your product, have a try, get some real testimonials, some real understanding that your product works, and then continue the ever-going really marketing activity. Continue asking customer the right question about what you own and what you are able to offer. In my career, I saw actually such a glamorous very painful failure, I would say, of a business that actually was very successful in creating a product, but it's what I call usually you sell a diamond like a furniture. It's like, for example, you quantify value for the customer, but then you don't profit from it. Yeah. Now, this is very, very important. The question you need to ask is, what is the lifetime value I'm able to offer to a customer? Okay. Can I sell on value instead of price? Yeah. Because if you sell on value, the customer will stay on value. If you sell on price, the customer will leave you on price. So say, for example, I'll give you a quick example about an hospital bed manufacturer I met actually 10 years ago. This hospital bed was capable of saving the hospital itself 5 days for the hospitalization of the patient. Now, for the NHS in the UK, 5 days, so basically the patient goes, he gets operated, and then goes home on the same day. Now, that is worth, every time you perform an operation, you're saving £5,000. I'll just give you an example, £1,000 a day for the NHS. Now, if you perform one operation per day, that's 30 days in a month, and usually that's the norm. You actually can do more than one. The value of that hospital bed is £150,000. Yeah. Now, if it costs you £8,000 to build that bed, the wrong way to sell it is outright, yeah, because you have created intellectual property, you have created an economic value that your customer is benefiting from forever, for 5 years at least. You know, the hospital bed should last. So instead of selling the diamond like a furniture, as I was saying before, so it costs you 1,000 and you sell it for 20,000 and you celebrate, you think you made 12,000 pounds profit. You actually sacrifice the initial margin. Say, for example, you sell it for maybe 10 or 12,000, you make a very small profit. But at the same time, you link that sell to a perpetual revenue you make on that utilization of the assets. Yeah, that's an example. And there are many consultants who are listening to us today, even freelancer who own intellectual property, who are generating economic value beyond the invoice they raise. Yeah, and when you create value for a customer, you need to ask yourself the question, what's the economic benefit I'm creating? And after you answer that question, you need to decide what portion of that economic benefit you're gonna assign to yourself.
You say something so right. I mean, selling on value and not on pricing. I believe selling on pricing, it's pretty much for you to be replaceable. You need just a lower price for the customer to walk away from you and taking someone else, right? So value is the very long time revenue stream for any business. But as today, because you are very skilled in finance, and again, I met so many founders very little skill in finance. My question is, how should I, as a founder myself, manage investments, cash flow, runaway? As I've been learning before school and after working, and then any company, they die on cash. All startups, 90%, they die because they run away of cash. And they can't get any more funding coming because, as you said before, you lack fundamentals. So let's say I go for my first pre-seed round, and maybe I think I need 300,000 euro, pound, or whatever it is. How should I actually manage my cash, making sure that the runaway is right, and when I do the second round, if I need, I'm not going to run out of money before closing.
Yeah, that's the mistake many founders make, because they tend to be over optimistic about how quickly the sales will come. So you haven't got headroom. Now, let's say this, when you raise funding, the best time to raise it is when you do not need it or well before you really need it, okay? So that's why stress testing scenario is fundamental. So you need to be prepared. You need to really make sure that you show an investor your financial intelligence. Now, let me be very clear here. Investors will only back financial intelligence because there are two big opposite in two different definition. The first one is risk versus opportunity. The second one is dependencies versus optionality. What do I mean by this? Founders, they always see opportunity. Investors, they see risk. Okay. Now, financial intelligence is supposed to balance things and to make sure that you are risk asymmetric. Yeah. So what does it mean? It means that you need to absolutely protect your downside, but you need to manage how you're going to reach your upside. Okay. So, and this is why when you really raise funds, after you get the fund raised, you have to manage according to milestone that you've established when you did your pitch, like when you actually raise money with an investor. But before you do that, you need to ensure that what you ask for takes into account of what happens when something breaks. Yeah. So let's say you assume that your first sales is going to come in 6 months. You need to stress test your forecast and say, well, let me focus for 12 months instead of 6 months. Yeah. Because I want to make sure that if something doesn't go according to plan as fast as I want, then you build that headroom. The other thing I've done many times with businesses is that they wanted to hire as fast as the budget was available. While in actual fact, you want to make sure that you link really the spending to the performance of the business. Say, even if you have a marketing budget, even if it's agreed with an investor, you want to make sure that you only start spending when the commercial side of the business has actually started to perform. So that's fundamental. Not only you need to perform, but you need to ensure that the reason why you perform gives you continuity. Because what you want to give an investor is the continuity. Is not just a one-off sale. Yeah. Don't forget about predictability. Building predictability is one of the biggest goal in a startup phase, which eventually will lead to a scale up. I also mentioned about optionality versus dependency. In business, you want to have as few dependency as possible and as much optionality as possible. So if you raise funding and you're going to be tight, you're going to have dependency. You want to have the opposite, optionality. So make sure you build a financially intelligent plan that will allow you to survive a possible temporary failure of the business as well. That usually is a commercial temporary failure. Say you wanted to raise something in 3 months, it's going to take you another 3 months extra. So you still have the cash to continue.
I mean, let's say my predictions are 3-6 months I will start generating revenue. It never happens because of my experience. I never seen really planning and execution by plan. Do you think 12 months on runway is the right benchmark?
I would say each situation is unique. I wouldn't say all the time. However, I would say 12 months is a good benchmark, is a good average about what you need to have as a runway. There are businesses that might need more. Okay. There are businesses who may not need 12 months, especially if it's a fast moving situation that requires, there's got lots of traction already. However, yeah, I would say 12 months, I wouldn't say it's outside the average of something very, very acceptable. What I would say to founders is make sure you have financial intelligence in your business, because the investors will need that confidence. They will need that trust. Trust is your capital. Trust is your currency. And the more financial intelligence you have in your business, the more you're able to manage situations when they become difficult. I always say great strategies are everywhere, but let's face it, great execution is rare. Okay. The investors know about this, so you need to make sure that you have this in place. Yeah.
That's right. It's unique, very rare to see the great execution. Absolutely. Strategy on paper are more or less all good, but executing them is a different story. But let me go back to you should fundraise when you don't need, actually, okay? This is absolutely right, and I endorse in many terms. At the same time, let's say I do my first round, okay? And because I need to still finish my MVP, or maybe I'm going to start scaling the business. The problem comes with valuation. Now, in Europe, now we start endorsing using SAFE. Before was very difficult until a few years ago. Now with safe note, it's easier to raise without knowing your own valuation. Although you have the cap, you have the discount, and maybe you are killing yourself because you are giving too much discount or your cap is too low and the conversion goes to 50% discount. Now, using safe actually is not that simple. Let's be honest. But my question is, how simple can it be for a founder, especially in early stage, constantly racing where you don't have market fit, you don't have revenue to show, and maybe you got already 400-500. If I'm an investor, I'm telling you, okay, you already got some money. Show me some traction. Show me some good KPIs, and maybe I will back you. But for the time you are going to show it, maybe you are running out of money. So it's a very tough trade-off, and maybe this is why very few founders make it, and the majority they don't make it.
Yeah, you're absolutely right. It's a tough world when you start to really see how things really work. This is why using a system that works will really help you. The system I'm obviously referring to is a system I created for the university back in 2017. Simple agreement for future equity are now very, very common because they will allow you to have an investor interested in your business, but bypassing the potential initial discussion about the valuation. But this is where also I would say many founders don't know about capital stack engineering. Now, capital stacking is very rare, very rare in a startup, capital stack design. Yeah. Something you really design. You don't just improvise, because most of the time people think, okay, we raise funds, hallelujah, everything is going well. Now we can continue. Well, ever think about what comes with the raising? What covenants do you have? Okay. So, for example, you have a direct loan. What's the sequence? Who gets paid first? Yeah. And now, do you have a bank loan? Do you have a direct loan? Do you have preference shares? Do you have ordinary shares? So, eventually, this is very there's very little attention to this in the early stage, but that happens because financial intelligence comes when it's only too late. It's only too late and you cannot fix things anymore. And investors in general, I would say almost always, they would want to ensure that the founders will control the business. So if you do not plan your rounds, your early rounds and your late rounds well in advance with proper capital stack engineering, you might actually deprive the business with millions and millions of valuation. Because don't forget, when you dilute yourself too much at the beginning without pre-calculating what the dilution is going to be, what is it going to do? Is it going to create a big discount on your valuation? A business that could have been worth, let's say, 20 million is now going to be worth 5 million. So these are things that require a lot more attention a lot earlier. And what usually tends to happen when an investor put money into your business, they would usually write an investment agreement in which they will want to monitor the investment, of course, but they may impose which person you're going to put in your finance team. Now, that is not nice for you as a founder, because you wish you would have chosen your own person before you actually raise the funds. It's almost like, your ends tight because you didn't plan ahead about the financial intelligence you needed in your business. I hope I answered your question. If not, let me expand on it. Yeah.
Yeah, absolutely did. Again, raising funds is not simple.
Mm-hmm.
It comes with a lot of, things that you must plan before raising funds. As you say, if I'm an investor and coming to you, investing in your startup, you are going to lose any majority. I'm talking about vote rights you can't run your business anymore. So there's no point for me to invest in you. When dilution is too much, again, the problem comes the same way. But this goes to my next topic, which is first-time funder, second-time funder. So the first-time funder, they make so many mistakes because the first time, and this is why many funders, the second time, they go much better. The capital structure is very important, but capital engineering is not simple. So you need to know, you need to go through the first, your first term sheet, your second term sheet, understanding all the clauses and ask that are included in any terms. They will investigate you money. They don't give the money for free. They want to protect the investment, and they want to make sure that you use the money in a wise way and not buying villa or Ferrari. And that's right, because it happened already before. But what's your take on second-time funders? Do you find them more skilled than the first-time funders?
Yeah, I always say second times you're gonna do better than the first one. It's all about what I call it always. You don't just react; you engineer and you design first. Many people think, oh, do I really need to design and engineer my capital? Do I need to design and engineer my valuation? The answer is yes, because valuation is not a calculation that happens at the moment you need the money. Valuation is something you design, it's something you engineer. That's why I call myself also a valuation architect. It's about architecture. Okay, so how do you go from first time funding to second time funding? Obviously a big help will come with the high valuation triangle, but at the same time, what you want to do is you want to make sure, what you tend to see is that people are more skilled at removing risk earlier, before the investor will find out about them, because there's a real equation in investor here, really. It's when the risk goes up, the valuation goes down. When the risk goes down, the valuation goes up. So the second time founder, they tend to have this skill. They tend to develop this skill thanks to financial intelligence. They anticipate the risk before they raise funds, and they are more skilled at removing dependency and creating optionality, which is what I was saying before. So very, very important. Yeah.
I believe when you've done many mistakes before, if you are a second-time founder, because unless you sold your first company for a good exit, in any way you learn a lot. So you know what means raising funds. You know what means having all the conditions that comes with raising funds. You know how you should protect your right votes. You know how you should keep control your company even when you are diluted to 20% share. So this is why we use dual shares. This is why many Facebook or Meta, whatever it is, any share belonging to Mark Zuckerberg, I believe they had attached 10 right votes, not one. But that's the right way to go. Again, you are the guy who made it. You are the guy who ran the startup. And if you lose control, no investors like it. Actually, they won't invest anymore for sure. I mean, would be a suicide. But should a founder have a mentor?
Big question. Should I find a mentor? I mean, the obvious answer is absolutely yes. I mean, I've been mentoring 91 startups, and I could tell how much they appreciated what I was doing for them. Now, obviously, it doesn't happen every day that you mentor 91 startups at the same time. But yeah, with 12 of them, I would say, or even more actually, I did a one-to-one with them, and I could see that after they did the session with me, after we met face-to-face in Riyadh as well, because I met all of them at once, we were then able to see how they were benefiting. I mean, the reason why a founder should always have a mentor is because our education systems do not really cater for an education that is needed. And also, the phrase I was saying before, great strategies are everywhere, but as I said before, great execution is rare. The reason why great execution is so rare is because you don't really get successful by getting it right the first time. Obviously, that's why the title of my book is "Fail People Scale." You need to learn how to fail smart, how to pivot decisively. Then you have to scale strategically. And the other reason why founders should always have a mentor is because they should think so much more about designing the future, designing and architecting the future. You do not do that by being on your own, and especially when you have to change identity from startup to scale up, that can cost you everything you built before. Yeah. So when you come out of the phase where you got your product on the market, and now you have to really you need to really become, you need to create value transferability effectively. You need to change effectively the way you behave completely, because initially when you started up your business, you were controlling everything, and control made it possible. But when you scale up, control makes it impossible, unfortunately. So that's where an identity change really requires mentoring.
But yes, I agree with you that startups need a mentor. Not all of them use mentorship, but I believe so. But what would be the role of mentor? I believe mentorship and advising are completely different. So if I'm a founder and I'm looking for a mentor, okay. First of all, how can I find the right mentor? Because if I find the wrong one, it can destroy me. The second one is what actually a mentor should do for a right mentoring.
Do not get confused. I will start by what not to do, really. Many people, they tend to think they're gonna find an answer on YouTube or AI chat GPT tool. Yeah. That's the problem. Yeah. Because what you're doing, you're accessing uh, information that does not really create the transformation you're looking for. So you're accessing knowledge. Knowledge is not intelligence. Not anymore, especially with AI. Acquiring knowledge today no longer requires really effort. Intelligence is different. Intelligence is about using knowledge to create an outcome. And this is why you need a mentor who has got the experience. Yeah. I always say that age is lever age, okay, as well. I mean, I'll say you need to, go for old people in general, because there are also young people who go experience as well already. But look really for experience, for people who have real execution behind their history, effectively. Yeah. So, for example, myself, I've done 5 M&A, 2 exit, 1 IPO, 520 million funding. I mean, find people who have that sort of knowledge, that sort of experience of doing things. Once you find that person, what you would like the mentor to do, you would like the mentor to help you become the architect and designer of your future, of your business. So make sure that you always ask the right question. The question that you need to ask is, help me really becoming a business that is chased by customer, by banks, by investor? How do I get customer attracted to me like a magnet? So a mentor should really teach how you create lifetime value for your customer. A mentor should also tell you how do you become a bankable business, for example. I always say if you go to a bank like a customer, you'll get charged by a customer as a customer. If you go to talk to a bank like an asset, you will be funded like an asset. So this kind of situation, you want really a mentor. And the other thing is, how do you get attracted to? How do you become a magnet for investors, for example? Yeah. So the mentor should really tell you how do you anticipate really the issue. You don't just wait for them. How do you become risk asymmetric, for example? So think think about, like an investor. Yeah, the mentor should be tell you what an investor is thinking about when you're sitting at the table with them, when potentially you are selling your upside but the investor, for example, is already creating the thinking about the downside protection. So the mentor should really make sure that you anticipate and you design as well.
Yeah, I mean, as said before, any founder must be very careful when it gets on board mentors or advisors, but even investors, right? So you need to find the people that really deliver what must be done for the good of your business, but even for your own health, because sometimes you get too much pressure and things can go pretty wrong. Now we are close to the closing, so let me ask you if you could, in few words, recommending something to all the founders, but not only founders watching today, what would you like to tell them? I mean, in terms of mentorship, also more wider in talking about entrepreneurship.
Yeah, a message to founders is I would say this: think about your focus, okay? You need to focus less on how hard you're working, but you want to focus a lot more about what you're building. Yeah. Why am I saying that? Because your effort does not create value. Structure does. Okay. So structure, not effort, creates value. So this is a very important message. So the real question for you is not whether your business is growing. Yeah. The real question is whether it's becoming something that someone will want to buy. Yeah. Because this is the harsh reality. Yeah. Most founders are building a job for themselves. Very few are building an asset. So going back to those three questions, what do you own? First question. So you need to you need to own an asset. You need to build an ownership. Number two, how does it transfer value? Because if it doesn't transfer value, it's not investable. And number three, how does it scale? Okay, so this is the message I would give to founders. Yeah.
Thank you so much, Matteo. If you want to remind to all people watching today your book, because I believe it can be very helpful for all entrepreneurs and not only that takes this road, right? Very difficult road to start a company and make it successful. And again, thank you so much for coming to the Mentor Talk. And I'm sure everybody will benefit for watching this episode. Thank you.
Thank you. So I'll tell you about the book. As I said, I had the book with me today. The book is called Fail People Scale. I'll show you the cover here. Now, Fail People Scale, as I was saying before, is not a slogan. It's a cycle. It's a cycle that belongs to the most successful companies in the world. They've all scaled after they pivot, and they all pivot after they fail. That is true for all of them, like, Steve Jobs with Apple, Jeff Bezos with Amazon, all of them, even Elon Musk with Tesla. You fail, you pivot in your scale. Now, why did I write this book? Because I felt really we live in a world where there are three big shifts happening that affect all of us. Number one, we live in an intangible economy where 92% of the value of the S&P 500 is made by intangible. So right now, data, the brand, the algorithm, they are worth more money than machinery, than buildings. Yeah. So that's fundamental shift. The second, we live in AI-driven economies. And today, we are traveling towards an era where you need much more professionalization. Now, if you're not AI ready, you're likely not to be investor ready. And Gartner said that 40% of AI projects will fail. So, which means the majority of businesses that I'm speaking to, they are not professionalized enough to be AI ready. AI will shape really the investment for so many companies, the funding. Number three, there is an unprecedented amount of private capital coming to markets. Now, we're not talking about in the next decade. In the next 48 months, there are 10 extra trillions of dollars private capital markets coming into us effectively. Now, that money is looking for businesses that are investable. You want to build a business that is chased by customer, by banks, and by investor. In this book, what you will find is the 5 stages of the business goes through: startup, scale up, stagnation, crisis, and exit. You will find the High Valuation Triangle, which is the system I designed for the university in 2017. And most importantly, you will find 26 self-assessment that you can measure yourself against now in 2026 or in future. The book is available on Amazon. You can find it very easily in 3 formats: hardcover, paperback, or Kindle. It's an evergreen book because you will definitely need it, not just in 2026, but in the future. It's not a motivational book. It's been written really for founders and for finance professionals in this new era where intangible economies, they make, for example, reading a financial statement no longer useful, because an investor will definitely not give you money based on your past, your revenue, or your cost. They will give you money based on what you own and what you are able to make transferable and what is scalable as well.
Thank you so much, Matteo. Thank you so much for all you've been sharing today and for taking your time with us today. Thank you.
Thank you for having me, Massimiliano. Thank you.